Welcome to Think Learn Finance. We have a lot to get through in today's episode, so let's get started. By the end of this video, you will take away the following. Whether you are in a good position to start investing based on your circumstances. What your core goals actually are and how they will be achieved. Important concepts such as risk, return and time horizon. A basic budgeting exercise. And finally, what barriers are keeping you from your goals. Let's start by taking a look at your current situation. In order to get to your destination, you must first understand where you are starting from. So consider these following questions. How old are you? Are you in a relationship, married, etc.? Who depends on you financially? How is your health? How is your job? Is it secure? Are you happy with it? What benefits does it provide? For example, does it include life insurance? Do you have any outstanding debt? This can be either long-term or short-term debt. And how well prepared are you for retirement? Please pause the video if you would like to take a couple of minutes to consider your answers. As we have developed a good idea of where you are starting from, let's narrow down what exactly it is you are trying to achieve at a core level. A good concept to help with this is PIPSI. So, what the hell is PIPSI? PIPSI is the 5 main demands and needs that people typically have throughout their life. These are protection. This refers to protecting what you already have, so that, in the event of your death or serious ill health, you are able to provide for and protect your family. Next is income protection. This refers to temporarily protecting your own income should you become unable to work due to an accident or ill health. Then we have pensions. This refers to ensuring a certain level of lifestyle is kept after your paid employment ceases. After this we have savings. This refers to stockpiling surplus income or free cash to either build capital, provide a safety net financially, or provide an income later in life. Finally, this brings us to investments for the purpose of sheltering a lump sum or regular deposits from the effects of inflation. This can also be used for capital appreciation. Some people may be wondering if you need all 5. Well, this depends. Some people will find all 5 important at some point in their lives. However, others might not find elements of PIPSI to be important and choose to only focus on 1 or 2 elements. Which of the 5 demands and needs are important to you? Please pause the video if you would like to take a couple of minutes to consider your answer. We have looked at PIPSI, and this can be considered as our why, and should help you establish your goal. Now we will consider how we will achieve your goal. There are 3 main categories to make this easy for you. These are capital preservation. This refers to protecting the value of your capital, or minimizing the risk that the value of your capital will decrease in the future. This is typically achieved through, but is not limited to, the purchasing of bonds, funds, or what we call in the industry, real assets, which includes things like property, for example. Next, we have capital appreciation, which could also be called growth. This refers to increasing the value of your capital to fulfill goals like purchasing potentially high-value material goods, building a retirement fund, or producing venture capital to start a business. This is typically achieved through, but again is not limited to, the purchasing of shares and funds, or through much riskier options such as private equity, derivatives, and shorting in volatile markets. Please note that these riskier options should be left to professionals, or undertaken by professionals on your behalf, as these can very quickly result in you losing all of your money, if you do not fully understand how they operate. Finally, we have income. This refers to using a lump sum or regular payments to build a portfolio, which produces a regular income upon which you can live, or use to facilitate a certain goal requiring a regular input of money, such as renting a store. This is typically achieved through, but is not limited to, the purchasing of bonds, and other income-producing assets, such as shares which pay a dividend. You may have a very specific goal that you want to work towards, but ultimately, how you will achieve your goal should fit into one of these 3 categories, a combination, or even all of these, either at different times or simultaneously. Which of these categories best suits your goal? Will you need to adapt your strategy as time goes on? Please pause the video if you would like to take a couple of minutes to consider your answer. We will now turn our attention to risk. So what the hell is risk? Risk is present in all investments. It can be defined as the potential financial loss inherent in an investment. When we say that risk is present in all investments, we do mean every single investment. There is no such thing as a free lunch. We do use a term in the industry which is risk-free. This is commonly used when discussing UK gilts or US Treasury bonds. These are not actually risk-free, we just consider the risk low enough, as it is unlikely that the governments backing these investments will default on their obligations. However, it is not impossible for this to happen. If anyone ever tells you that an investment is 100% risk-free, they are lying and should not be trusted. So how much risk is too much risk? This is extremely subjective and is unique to each person. To understand how much risk is too much risk for you personally, you will need to decide how much of a loss you can tolerate should things go wrong. This could be expressed as a percentage of your capital or a monetary amount of your choosing. Please remember that the risk you can tolerate is different from the amount of risk you actually have capacity for. When we talk about your capacity for risk, this refers to how much risk your portfolio can actually handle, and is a factual measure. When we talk about your risk tolerance, this is how much risk you can tolerate emotionally. For example, you might be okay checking your portfolio, and seeing that you have lost £200 overnight. This is your risk tolerance. However, if your portfolio cannot withstand a £200 loss overnight, and this greatly affects its stability or value, then this is your capacity for risk. Now let's look at what the hell is return. Return, put simply, is the potential financial gain possible from an investment/trade. Please remember that past performance is not indicative of future results. Finally, why the hell do they matter? Risk and return matter because without risk there can be no return, and if there is no return, then why take the risk? There will be future videos on the different types of risk present in the stock market and individual investment types. Now you have a basic understanding of risk, you will need to consider your risk tolerance and capacity for risk, given your circumstances and capital available. We now understand our goal, risk, and the type of strategy required to achieve it. Now we will look at, what the hell is a time horizon? A time horizon can be summarized as the length of time in which you plan to achieve your goal. This greatly affects your specific investment strategy used, amount of risk needed, capital required, and much more. Theoretically speaking, the longer the time horizon, the riskier the strategy can be, as there will be more time to make up for any losses that may take place. However, in reality, this is not always the case. Always choose a sensible time horizon after a period of quality, unbiased research across multiple topics, potential outcomes, and market conditions. Once you have done this, you can then decide your time horizon. Next, let us look at what the hell is your ability. Depending on your ability, and how much time you can dedicate to your investments, will greatly affect your investment strategy. Now we won't cover individual investment strategies, these will be covered in another video, but something to consider is that, naturally, if you have a lot of time but not a lot of knowledge, then you may want to consider a lower risk approach, such as the use of funds in your portfolio, or dedicate more of your time to learning the fundamentals of the stock market, investing, cycles, correlation, and so on before looking to build a portfolio using shares, or more complex investments. Please note that shares are widely considered as medium risk, and are not suitable for all investors. Always ensure you do your research, and seek financial advice if you are unsure. So, you have a solid idea of your current situation, goal, strategy, and time horizon. This brings us to the most important page so far. Can you afford it? This is where the work comes in. A huge majority of people have never taken a good hard look at their finances, yet it is incredibly easy, and incredibly powerful. Why people don't do this is for a number of reasons, but it can be that they simply do not care enough, they are lazy, or they just don't know how. This leads to a large number of people making poor, ill-informed decisions, which quickly lead to their goals not being achieved, and the early withdrawal of money because it is needed elsewhere. So, how do you do it? Simply grab a piece of paper and write 2 columns, income and expenditure. Then fill each list using your monthly figures, like so. Here you can see we have a monthly income of £1,272.50 and a monthly expenditure, also known as outgoings, of £745.50. Once you have your 2 columns filled out, simply take your total expenditure from your total income. This will leave you with your total free cash available for spending, saving, and investing after your important bills have been covered. For example, total income minus total expenditure equals total free cash. Or £1,272.50 minus £745.50 equals £527 free cash. So, can you afford it? How much can you afford for each activity and what is the split, if any? We will now start to bring this video to an end, but before we do, we will consider, what the hell are your personal barriers? We have looked at ability, finances, important concepts, and you should now have formulated a fairly solid idea of whether you feel you are in a position to be investing at this point in time. If this is you, then congratulations. If you feel that you aren't in a position to be investing at this time, but you would like to be, then you need to use what we have discussed and your own research to determine which barriers are standing between you and your goals. You can then work towards breaking down these barriers before turning your attention to your goals. Finally, what the hell about tax? Naturally, it is not possible to discuss tax and it be relevant to everyone worldwide, so it is wise to do your own research regarding your own local tax situation and how your investments will be affected. Please keep in mind that tax can have a massive effect on the return on your investments and finances, so do not leave your tax considerations until last. Choosing the correct tax wrapper for yourself at the start of your investing journey can save you a lot of stress and money down the road. If you learned something from this episode, please hit that like button and subscribe. Don't forget to check the bell icon to be notified of our new videos. And remember, not everything that shines is gold. Catch you in the next episode.